and running around.
Ah,
Oh,
you gave
cool.
me permission. We're set.
So yeah, this one's near and dear. Um, I'm really like pleased to have an opportunity to work with you guys again. Um,
Cool.
your model is just awesome. It's really cool. So I kind of wanted to kick off the meeting and just kind of meet and greet, get a little bit of background from you guys, and have you guys present your model instead of me.
For
uh,
sure.
so I'll hand it over to you, Emily.
Yeah. So everybody doesn't know, I'm Emily. I'm the co-founder of Sage Investment Group. We specialize in taking like 2-star hotels. I always struggle to get people to understand like the really gross, disgusting ones, sometimes referred to lovingly as roach motels, and converting them into affordable, not excuse me, attainable housing. So small studio apartments. Our target is the missing middle. So they're not subsidized in any way by big government or anything like that. They're just trying to find. We're just trying to provide quality housing for our hardworking people who very often have a hard time finding things that fits within their budget. So sometimes we do end up, as the nature of it, helping people out of homelessness in different situations, just because we provide that housing that is so desperately needed across the country. Depending on the stats that you're going to read, somewhere between 7.2 million units of housing are short in this country. So we're working on being able to provide that as quickly as possible. We're able to generally do that in about 10 to 12 months, depending on the turn time. So from a time perspective, there's just about no one faster at adding housing to our country than us, which is something that we're pretty excited about being able to do and make an effective change in a timely manner. So that's high level what we do. And we kind of, as many of you guys have known, went through Kenji's class, we essentially operate the BRRRR model on a really big scale. So we buy them, we reposition them. Well, first we actually rezone them, do the whole thing, change their zoning, change what they actually are from a hotel to a multifamily property. We get them all repositioned, retenanted. Generally 18 to 24 months later, depending on the market, we'll do a cash out refi if that's an option. If not, we go to sale. And then if we do cash out refi, we hold them till again peak ROI, generally between years 3 and 5, and sell them at that point. We take that cash, we roll that back into another property, continue to do the whole thing via 1031s. So really big BRRRR model with just converting one asset class to another asset class. So it's complicated, but it really is just the same thing you saw in 2010 with people flipping houses out of foreclosures. It's just that the same concept holds true at almost all levels is what we have found. We found this niche in 2019 when we bought College Studio Housing, and it was a hotel in Tucson, Arizona. And we realized that this could work for more than just studio housing, because COVID made us learn the hard way that it could work for non-studio housing when they took all the students away. And we realized that young urban professionals really wanted to be able to move out of mom's basement. And that the new normal of COVID is to not have roommates, because everybody, I feel like, had a bad roommate, or even had a great roommate and realized that they still didn't like them. So we have a massive demand in this country for studio housing. So that's high level what we do. My husband and I, co-founders, we have Ryan Sudak. He's on the call, Ryan Wave. And he just joined us recently from M&A with Redfin, and he's going to be helping us take it to the next level. Our goal is to have our fund worth $1 billion in the next 7 years. So right now we're tracking at 180 million. By the end of the year, we will close. Ryan, what are the stats on that? How many more are we going to close for the end of the year?
Well, we just closed one this week. We have another 4 that are closing between now and the end of the year. And then we've got a big pipeline behind that. Deal level returns all above 30%. So pretty excited about the pipeline. And a lot of that comes from the forced appreciation from the hotel BRRRR model, if you will, just because multifamily assets are valued a lot different than hotels are.
So they're really exciting. They're dynamic. Something when you guys are talking, I'm handing this torch off to Ryan here shortly. Right now I'm our lead fundraiser. So I raise about 50 million a year in equity. On average, that ends up being, somebody's got me on speaker. I can hear the bounce back. that ends up being about $1 million a week. So I talk to people like you guys all day, every day. And what I have found is that, yes, the high level numbers are great, but some things that I'm also going to throw out there today too, for you guys to be aware of to help sales, is that we are providing massive amounts of housing to our country. Our last unit that we brought on in Fife, it was 96 units. Of those 96 units, 12 of the people of our tenants were coming from homelessness, not because they couldn't afford it, not because they couldn't pass a background check, but because there was no housing available that they could afford within their budget. So being able to provide that service to the community, the other huge thing that we do that is like just awe-inspiring to me, and I'm so incredibly proud of, is that when we come in, we average a reduction in crime anywhere from 40 to 50%. In the Tacoma, Washington area, where we've been buying up a street called Hosmer Street, arguably it was the most dangerous street in the state of Washington 18 months ago. Everybody thought we were crazy when we started buying there. Honestly, I didn't think that they were wrong. We've been able to reduce crime on that street dramatically by over 50%. But the most important stat there is we've been able to reduce violent crime by almost 100%. That street used to average 20 murders a year. It hasn't had a single murder in the last 14 months. So that's something that we've been hugely able to help change, revitalize community, become a part of the community, and to get rid of that crime that included drug trafficking, human trafficking, weapons, all the grossest, nastiest things of the economy. So we're really able to make an impact in terms of housing, the community. Of course, we're taking something, we're revitalizing it. We have a great carbon footprint compared to building something new from scratch. So being able to hit those points, as well as not only is this an investment that has a phenomenal IRR, Ryan is leaving some metrics in the chat as well for you guys to have on hands. I mean, having an IRR that's above 40% is pretty insane. But on top of that, we're also doing good things for the community, good things for the environment, helping reduce crime and helping reduce homelessness. I mean, it almost feels a little bit too good to be true. So those are some helpful points that I spend a lot of my day talking about. So with that, I was going to throw it back to Nathan and see if that was what he was hoping for from me, or if there was another angle.
That's great. Thank you, Emily.
Mhm.
That gives us a really good idea, not only about the returns, but the mission that you guys are going after.
Mhm.
And I think I've actually experienced some people say, "Hey, this is too good to be true." And I think part of that was like just kind of understanding, at a portfolio level, you're able to pay LPs more than what they would get if they just bought a single property. And you're
That
really,
was our goal. Yeah. So Ross and I started this, and I mean, I can get back to the history of it, but we were really trying to find a way to add a second or like passive income into our life. I had a job at Microsoft. He the goal was for him to own his parents' painting company, and we couldn't figure out how everybody could afford daycare. Honestly, that was where we were at. We were young. We were just married. And so the goal was to create this passive stream of income. And the challenge that we ran into is that real estate isn't passive. And so they sell it this way, especially podcasts, that it's this passive stream of income. It's gonna be so easy. And then every single time we would go on vacation, I'd get anxiety sitting there waiting for the plane to pull back, because I knew one of our tenants was going to text and say, "Hey, the toilet's clogged." And then I was going to have to deal with that. And so when we started to develop Sage, we wanted to be able to provide a truly passive stream of income for real estate that had the same returns as owning it yourself, if not better. And so that's something that we've worked really hard on. And we're really blessed to have found this niche that's been able to help us achieve that, and to be able to pass that on to people that have the same goals as we do. I mean, we didn't come from trust funds. We didn't have a silver spoon. We were just bootstrapping it, trying to figure out how to afford to make sure our kids were, well taken care of.
yeah, I get it. My dad's a firefighter, made 50K a year, single, breadwinner.
Mhm.
So there's no silver spoon for me either. Understand. I think one of the things, there's a few questions that are popping up in the chat. If people want to pop questions in there, or raise your hand, definitely love to bring you up and have people ask questions directly and get some dialogue going. I think one of the questions that kind of at a high level that folks had was like, I guess in light of the success that you've had, that Sage has had, and the rapid growth, how are you dealing with that? And then specifically having to do with, you know, that we're in a high interest rate environment. there's some loans that maybe have near-term loan dates. So just kind of high level, what's your strategy there? We're interested in that.
Yeah.
I can hear a little bit about that.
We're absolutely growing insanely quickly, for sure. That is our biggest thing, is making sure we don't get out in front of our skis, for everybody who understands that analogy. Part of that was bringing in Ryan and stealing him away from Redfin. We've been working on making him come join our crazy crew for what, I don't know, 18 months. I think Ross has been working on it longer. So having the right leadership team in place. We also recently hired Grant. Grant, can you give a wave? Grant's going to come over and help us out with more investor relations to ensure that we get that same level of customer service. Something that Kenji and Letty and I have always I felt soul bonded over is how protective we are of our clients, our investors, students, however you want to phrase it, but it's something that's very important that we have a very high level of customer service. So Grant's going to be here to ensure that as we continue to grow, that is a factor in it, but it's really strategically growing our team and putting systems in place in order for us to be able to make sure that we're able to keep our budgets in line, our timelines in line, making sure that we're getting good deals and that we're having scalability across the board. So from a high level, we're being very, very strategic in how we're managing the growth of our team. And believe it or not, while we're growing quickly, we are still turning deals away because we don't want to get ahead of what we can handle. We recently had a huge investor say, could you take $100 million check? We said, no, we do not have the ability to take that right now because it would put us out more than what we felt like we could handle and the responsibleness for our investors. So we're trying to grow at a manageable pace. It is very large and crazy, but we feel like it's within responsible limits. I'm going to let Ryan talk more about loans because that's his wheelhouse and he just gets giddy about it. And Ryan, want to take it away and talk about loans and why they're so crazy right now?
Yeah, and I think we got Ross on the phone too. So Ross, you can keep me honest here. So yeah, I think building infrastructure of the team, just touching on that really quick. So we have about a team of about 17 folks based here, mainly in Washington. And then we have some acquisitions team members that are in Tennessee, helping us find properties, all across the country. And so those 17 team members are responsible for investor relations, responsible for finance, accounting, making sure that we deliver K-1s and all of the tax forms in a timely manner. We work with PricewaterhouseCoopers as our external accountant that prepares all of those tax forms for us. They're a reputable, one of the big four firms for those that are familiar. So just have a lot of infrastructure there. The other part of that team manages all of the construction teams that are out there renovating the properties. It's really important that we execute on time and under budget where we can. When we're taking on these projects, they're really complex. We're spending millions and millions of dollars on each one of them. We've got very defined scopes of work with contractors that we've worked with for years. We actually have two main contractor relationships. One of them is actually multi-generational. They grew up down the street from Emily and her family. And they do a lot of our work in Washington, and we have a national partnership for general contracting outside the United States, outside the state of Washington. They do a company called Renew does all of our projects outside of Washington. That's another part of our secret sauce is those contractors really do right by us. And we've got a really strong relationship with them and also strong oversight to make sure that we're delivering projects well. On the loan side,
just to add one little thing in there. Our Washington state contractor that works for us is also our third largest investor. So not only is he our contractor, not only have I known him since he was 2 years old, but he is our third largest investor and was Ross and I's original partner in our first rental property. So the history goes way back and there is a huge amount of oversight, and he is highly motivated to ensure that our projects come in on budget and on time because his money is very much involved as well, to the tune of 7 figures.
Yeah. Great point. So as far as our loan portfolio, right now we own 22 properties that have loans against them. We currently own one property that has no loan against it. We own 23 total. If you look at the maturity dates of our loans, we have some loans that have 30-year terms. So there are actually 3 of those that don't even mature until 2052, and they're fixed rate loans. There are some loans that are coming up on either a maturity date or an adjustment date over the course of the next year or two. And I can break down the stats if people want to geek out on the stats. But generally speaking, most of our portfolio has maturity dates that are at least they start kind of like 3 years from now. And we've got half of our portfolio has maturity dates past 2029. So we feel really confident about our stabilized assets and kind of the assets that are in our portfolio. The ones with shorter maturity dates, usually those are projects that are under renovation right now. And we have a bridge construction loan that are on those. Meredith, we can geek out on it. So those bridge construction loans, usually they're up to 3 years in term roughly. And the goal is to complete the construction project and then do a refinance into a more permanent loan. That's pretty easy to do because we're forcing the equity appreciation of the asset when we convert it from a hotel into a multifamily asset. And so we can make that conversion. Sometimes we work with lenders who structure the product so that that bridge product automatically converts into a permanent loan. So it's kind of a lot of different flavors there. Ross, I don't know if you're still on. Is there anything I missed there? Anything you'd like to add?
Yeah, just the one thing that I wanted to add there is that these loans that are 3 years by design also have an emergency lever, which is a +1. So if we want to extend because for whatever reason the economy is not supporting a refinance or anything really, we have an ability to extend for 1% of the loan amount as a fee for an additional 12 months.
That's
Outside
excellent.
of that, you nailed it.
That's excellent. Thank you, Ross. Thank you, Ryan. I was super interested to receive that document from the institutional lender and the vetting that they were doing with you guys. I was curious.
86
also,
questions. Yeah. When you asked for this meeting and said we've got a bunch of questions, I was like, I got 86 answers. Yeah, that was a little brutal. They're a bank out of the Middle East, out of Doha, and we just passed vetting. They have signed on. They've agreed to give us significant millions of dollars. They're very excited to be participating. We're going to do one trial property with them. All goes well, they're willing to write a check for 50 million next year. So we're really excited about them. They're really excited about us. It seems like a good fit. But yeah, they put us through the ringer, which was great because now we have it all on paper and it's been recorded. So that's fun to be able to share with you guys and to show off what we're doing and to, come out of the vetting standing and head held high. It always feels good. So
absolutely. Awesome job. Thanks for providing that info. It's tons of insight for us. And
yeah. And then I'll also
Yeah.
be providing, Ryan just finished a beautiful update for our Q3 performance. So I'll be providing that as well after this call. I'll send it over with whatever else was asked for in the chat. I see Ryan's taking notes. And we'll get that sent over as well. But Ryan's got a beautiful breakdown of where we're at currently. Things to note, where we're headed. We are increasing our share price to $1.50 starting January 1. That is the biggest thing I'm leveraging right now in terms of my personal fundraising. It's really helped me push everybody over the edge because there is no exception to the change in the share price. Even my mother does not get an exception to the change in the share price. So as of January 1, that's it. So if anyone comes in late or a wire even hits late, this happened to me last year. It made me so nauseous. Somebody sent a wire on the 31st. It didn't hit in time and they were at the new share price, not at the old share price. So we have hard stop December 31st. Your cash is in, you're at the old share price. Your cash hits the wire January 1. It's the new share price. So the new share price is $1.50. That's a 5% increase, which is given the economy right now and the cap rates and everything happening and a lot of multifamily losing value. We're excited to see that our property is up. Other thing to add into that number is that doesn't account for our 6.2% distributions that we gave this year. So we're really looking at close to over an 11% return for our investors in 2023, which was kind of a crazy year. So I'm feeling pretty proud about being able to provide that to our investors. So that is a big factor right now. If somebody's trying to make a decision, they also, with investing this year, we do not prorate our depreciation amount. So if they come in as an investor in 23, no matter where they entered in the year, they still get their full scoop of depreciation for the year. So now is a great time to get in. You get in at the discounted, old share price, and you get that full scoop of depreciation. So that way everybody can get those wonderful tax incentives. Because, that's the best part about investing in real estate, in my personal opinion.
Absolutely. That's a great benefit. It's a question that came up on the team, I think, yesterday. about
And
the
just to give a
appreciation.
little more context on that share price calculation, we had an independent third-party appraisal company value our properties as is. Within that, I mentioned we own 23 properties. One of those properties we just purchased. Some of those properties we've just acquired in the last month or so, and they're valued at what we paid for them, even though they've been fully capitalized for the construction costs to renovate them. And when they're done, their valuation is going to increase by at least 40%, perhaps more for some of the, depending on the project. And so that's not accounted for. And so as an investor in Sage, you're getting shares in Sage, you own a piece of our entire portfolio that we own today, as well as what we're buying in the future. And so while $1.50 is the current value of the shares, there's kind of some like pent up appreciation that's under there. Like if we were to buy nothing else and just complete the projects that we have, our share price will go up. Because we're valuing our portfolio on an as-is basis, not where the projects will be once they're finished completion. Does that make sense?
It does. Interesting. So there's an inflator there. It's built in. I wanted to ask, well, actually, before I ask this question, there's a couple questions in the chat. I want to make sure folks have a chance to ask those. I think, Shirag, did you want to pop on, or I can just ask the question for you? It's up, either way, it's fine with me.
Yeah, it looks like it was actually answered already.
Okay, cool.
I was just wondering about whether there are qualified opportunity zones, and it sounds like the fund is not necessarily structured that way, but it sounds like some of the properties sort of are.
That's right. We own a couple properties that are in Lakewood, Washington, that technically fall within an opportunity zone, but we're not, structured to, take on the, kind of all the opportunities. We're not structured as an opportunity zone fund. So it's possible that a developer will look at those very attractively when we eventually sell them, because they could take advantage of the opportunity to be within the opportunity zone, but it's not a strategy that we're employing.
Got it. Thank you.
I guess
So
along
let's
the same lines. Oh no,
Nope.
go ahead, Emily.
I was just going to answer some questions in the chat, but go for it, Nathan.
Oh yeah, I was along the same lines. You guys have had some great success with selling to housing authorities, and I think one of the Fife property, one of the local tribes purchased that property when it was partly renovated, just the exterior, I think.
Yeah, we decided to actually finish that one off. So we decided to keep that on and continue to negotiate with them over the terms. We're going to push forward and follow our model. We just feel like there's so much appreciation to be had, and to keep that project rolling forward made a lot of sense to us. And the tribes have a very lengthy process that I don't think we were entirely prepared for. To have to get a unanimous council vote is not an easy thing. So we're going to continue negotiating with them over the coming months and years, but right now we're going to keep pushing forward and convert that, just because we saw such insane success with the property across the street, and we got such a higher rent price point, honestly, for that property, that it's penciling so beautiful that it's hard to let go of when we can hold these things and have such beautiful cash flowers and have the value just continue to increase.
Yeah, one thing to double click on that. So a number of our properties are in Pierce County, Washington, and the property that Emily's talking about is located there. Each year, the U.S. Department of Housing and Urban Development publishes fair market rents. Those rents are used for voucher programs and other agencies that provide subsidized housing for that property. For Pierce County in Washington, if we look at our properties on average, they're seeing a 22% year-over-year increase in what the Department of Housing and Urban Development believes they should rent for. So we're really excited about the future net operating income growth and the rent growth that'll be coming in our portfolio.
That's awesome. I noticed for Olympia, I think the target rents are $1,250, and the fair market rents from HUD for 2024 are over $1,300. So it's like 93% of the HUD number. And then you guys are including utilities, right?
Yeah, utilities
so-
are usually on top. Yeah, go ahead.
No, go for it, Ryan. You got it. I do this all day long.
Utilities are on top. We have a utility and technology package fee. We cannot make a profit on utilities. That is just a pass-through expense to our tenants. But we do provide them with cable and internet, HBO, the whole lot. And it's all one bill. Our tenants love that because they don't have to go out and fill out applications with all the utility providers, manage all of those payments every month. And it's part of that kind of fully amenitized studio unit package that we provide, with everything in the unit that you need to live, including your utilities and internet cable, and then all the amenities that come from it being a formerly operating hotel. The Olympia project, I hope you guys check out the renderings and share them around with potential investors. We're putting pickleball courts in. It's a 12-acre property overlooking the lake. It's going to live beautifully.
I would love to have a copy of those renderings. Definitely.
I'll include them
Yeah,
in the list
thanks.
of things I sent over.
Awesome. Thank you. Yeah, so that comparison is apples to apples. The target rents for you guys and the HUD comps. The utility package is on top. It's a single bill, very attractive, but you're under the market rents by 7% or more. Sounds like on the Olympia property.
That's right. Yeah, and that's right. In the case of the recent Fife property that we launched, almost 100 units, we're at 1250. The HUD market rents are going up to 1430.
Awesome.
I'd like to mention something there real quick, if I could.
Absolutely.
I posted the renderings in the chat, and I just wanted to state that the rents that we've estimated for Olympia have a lot of upside. So you're identifying that at the HUD level, and HUD is typically undershooting what the market is willing to pay. So for Tacoma, having increased from $11.73 a month all the way up to $14.30 on the HUD FMR is a representation of the market. The market sets the rate, and the HUD follows it. So we're already getting $1,250 plus $250, $1,500 gross in Tacoma on fair market rental rates. Now our subsidized tenants are going to be able to afford to stay and pay. And so that's the benefit of the government catching up to the economic reality of the region. And we're very understanding of what's happening in the region. And we are continuing to provide housing as a result of the lack of supply. And then the demand is obviously taking its toll on the market as everything gets more expensive. So that's happening certainly in Olympia as well. And I expect to overachieve. But when we are looking just at the raw data and the numbers, we're not speculating on the future. We're just underwriting for what we know can be had today or at the time that we're underwriting it. So there's a lot of potential there.
Sounds like too, Ross, there's from what I remember learning from you guys in the past, you have 6 or 7 competitors in the same niche, but your cost is 50% or even better of your competitors because you have this alignment of interest with your 2 major construction firms.
That's right. Yeah. And it's about $37,500 in state for our average rental unit or a renovation to full turn into R2 from hotel. And that's including all of the exterior and the amenities. It's all wrapped up into that number per unit. And then out of state, it ranges. If we have really low needs at the property, we can be as low as 27,000, as high as 45,000 when we get into tricky situations like abatement of lead and asbestos. But certainly our alignment and our relationships and our knowledge of the industry and construction, it provides us a significant competitive value advantage, and we're able to get things done for much less than our competitors. I've spoken to the majority of them, and they're $75,000 to $80,000 a unit, and they can't get out of their own way. That's for sure.
Awesome, thank you. I want to go through, make sure everyone in the chat had their questions answered. I see Meredith wants to geek out on the loans, and that's awesome. And Leti and Kenji were asking about investors invest in 2023. An explanation of the impact.
Thanks, Nathan. Yeah, I just want to be able to explain to the investors what that means. So, the number of investors, we have a couple of investors who are coming back and investing more money. They invested in some of the, earlier in the year. And so, they've been getting 6.15% annualized. And so I guess the question is, when the share price goes up to 1.5, what does that mean for their distributions next year? What does that look like?
Absolutely. So every year we base our distributions off of the current year share price. So what will happen is that everybody who invested in 2023, their distribution percentage will go up. So right now, all the 2023 investors are getting 6.2% APR for the year. I believe that the 2022 investors are getting something like, God, Ryan, you're way better at remembering these numbers off the top of your head, but I want to believe it's in the 8s. And the original 2021 investors are in the 9s. So the way that that's happening for them will continue to happen as we go up, because we continue to pace that baseline. While we don't have a pref, we've made the commitment to try and to go no lower than 6. Now things can crazy and can happen. So, contractually things might need to shift, and we have to make the best call for the fund. But as long as we can, we're going to continue to have distributions going. So next year, the goal is to increase them based off of the new SharePoint, at least that base amount of 6. Now we do have a distribution that hits in January. That's Q4's distribution. So that counts towards 2023's percentage. So where you'll see the increase will happen in April when that distribution comes out, because that's Q1's distribution. I always get that call in January, like, hey, you said, I was like, oh, well, these are technically 2023's. So that's something to note there. But right now, Kenji, to your point, is a great time to double down. Ross and I are doing the same thing. We're moving things around. Our goal is to sneak in as much cash as we can by the end of the year. Ross and I are the largest individual shareholders in the company. Our goal is to try and stay that way. Luckily, so many people are starting to believe in us. That's getting a lot harder to do. That feels really special as well. But right now we're the OGs, and we're trying to keep it that way, because there is some risk in private equity and in real estate that, you guys all know this. It's not a streamlined thing. It's not FDIC insured. So it feels good for us to be able to say, hey, our money is where your money is, and into a really huge scale. So our money's where our mouth is. So I hope that gives you guys some level of comfort.
And distributions, Kenji, maybe this is part of your question too, to emphasize to investors, is when the funds hit our account, we start basically accruing against that distribution. So if someone was to send in their funds, if the quarter is 90 days long, let's just say, and they're in for half the quarter, they'd get half the distribution. So whenever the funds come in, that's when the distributions start accruing for them.
Yep. Yeah, I think we've done 2 distributions now. So yeah, we're deep into that. But yeah, I wasn't sure what happened in the next year. That's cool. So the other question that I just want to make sure I understood was, so I can explain this to investors, is about the K1 that they're going to get. So you were saying that even if you wired fund, or even if an investor is in the group where we wire funds to you guys in December 2023, you're saying that investor is going to get the full year 2023 losses, or they're a share, like as if they invested January 1, 2023.
Yep, that is how it works. I know. Kenji, I literally asked Ross yesterday, I was like, I'm not wrong, this is how this works. And he's like, you're not wrong. So it is a very Ryan, do you have something to add?
I was just going to say it's pro rata based on your ownership. So take the number of shares, and right now we're like 48 million shares out there. So if you own 1% of that, you would get 1% of the depreciation flowing through to you.
Yeah, but it's not prorated based off of where you came in the year.
Yeah. Okay. If I can ask one more tax question, what about for the GPs? Like, what about for this group here? Like, so, if we own a portion of, let's say, Columbia 138, right? How does that work? Is there any depreciation or losses allocated at the property level?
Unfortunately, no, only if you guarantee the loans. That's the only GPs in this case. It is a little bit different than a syndication because it's a fund versus a syndication. The IRS views it a little bit differently. So the only GP that gets a portion of the depreciation is the guarantor of the loan.
Yeah.
Unfortunately.
Okay. No, it's, I think.
Trust me, we wanted to figure out how to make that one work. Personally.
Yeah, no, I think it's consistent. I mean, that's consistent with what we understand, which is that, ultimately as a GP, if you don't have skin in the game, which is what you're saying, being a guarantor of the loan, if you don't have money at risk, then none of the depreciation can go to you. So that's pretty consistent. So, and we've had these conversations internally. Just wanted to make sure that I understood that. Thank you.
No, we haven't found a loophole that you haven't found. We're looking. I'll let you know, but
okay.
no. Okay, it looks like Samantha has a question. I'm curious how you decide which properties to sell or to hold on to. Sounds like if the ROI is still increasing, you may keep it. Sorry, it moved on me. If you decide to hold on to any of the properties that we are GPs for, we get paid out only if that property sells. Yes. No, that's actually not the case. I'll get to it. But if you held it, say, another 2 years, the sale price would increase, which would increase our profit. What happens if you decide to hold on to one long term of those properties? Okay, so the way this works, we generally explain it to keep it simple, since most people aren't very versed in how GP profit sharing works, is to say, oh, well, you'll see it at sale. Now, if we do hold it long term, the second that the LP capital is returned in each property, then those GP shares become activated. I have to look at the numbers. Normally, this happens between years 4 and 5. Generally, we've been projecting sales about years 3 and 4. So if we do decide to hold it, do a cash out refinance, and then keep it for a longer term, you will start seeing a distribution off of your general partnership shares as soon as that LP capital becomes whole again. So if we do decide to hold it, you'll just get a distribution off of your GP shares. And yes, we do what is best for the property and what's best for the fund as a whole. So when Ross and Ryan do their analysis, they will make the call when the ROI is at its peak, and that's when we sell them. So I hope that answers the question for everybody on the depreciation, but you could in theory get a distribution off of it. We've generally sold them before that, but as we start to stabilize our portfolio across multiple different entities and metrics, we could get to the point where you could see that. And we will, of course, announce that because we'll be excited about it too. All right. Yeah, so Ross put the renderings in there. I mean, it's Olympia's pretty unbelievable. It's definitely on the list of properties I'd live in. Has a lake. It's cool. It's peaceful. I'm excited too. I don't know, for anyone who doesn't know, Olympia is Washington State's capital. So there's a lot of people that commute in for the week, work for the week, and then go home on the weekends. So we think that that's going to be a huge draw for those kinds of people that are looking for nice, clean, affordable housing that they can be at a couple nights a week while they're in working at the Capitol.
That's great. It is a really beautiful location. I spent a lot of time. There's Percival Landing down there. There's all kinds of attractions and amenities right around the property within a mile or less.
Yeah, and there's a lot of great transportation. So generally something that we look for when we're purchasing a property is access and easeability to public transportation and job centers. So the number one expense for our tenants is housing, hands down. The highest expense is transportation. So being really conscious of that is something that we've learned is vital to the asset class that we live within, that we work within. So making sure that we have one, secure parking. We always put in the best of the best, these beautiful iron gates that go all the way around the property, keep them really safe. We've got automated gates where I believe they're face recognition on them, and customized key codes so that everybody can have secure access to the private parking lot. But then we also ensure that we're by mass transit, whether that be bus, rail, line, whatever it might be. And then most of them are also in highly metropolitan areas where we're able to, walk to work, because it's an important factor as well.
This is amazing. And it's helped to answer a ton of questions that we had. I don't know if anybody else has any kind of last questions they wanted to ask.
You guys are going tame tonight. Like the last group was like brutal. I like mentally prepared myself for this call all day, you guys. I told Ryan, I was like, last time they were playing the game of gotcha, and I like felt like I barely survived. So please, if you have questions, don't hold back. I'm happy to. No one's got me yet, but last time there was like a whole joke about how many buckets of money I can make you. So that's continuing to be my goal. Well, here we go.
Here comes a football helmet.
Exactly.
I locked my door because Benjamin was and he'll start running into the door. So
Ryan's daughter is so cute. He's got a glass door at home, and she's like, Ellie, oh my God, she's hilarious. Ryan might need to change those doors out.
Yeah. Aditi, did you have a question?
Yes. Hi, Ryan. Actually, this was a question reference to what you had mentioned earlier. So we wanted to ask this question more in terms of, the anticipated expansion of cap rates in the commercial real estate that we foresee in the next few years. So thank you for sharing your loan maturity schedule. We have that sheet with all of your properties. And you had also mentioned, I think, a couple of things that I wanted to ask you about was, in 2024, you have the Indy 183 due. In 25 is the Wichita 122, which is up for payment, and 2026 is the Tacoma 134. The rest are smaller properties. And of course, in 2028 is all of the Columbia and Centralia that you did this year. So for these three properties, which are larger, more substantial properties, which have balloon payments due in the next 3 years, are they purely balloon payments where you'll be forced to cash out refi, or do they have a built-in loan at the end, which makes it safer?
Yeah, I'll let Ross jump in for two of them. For one of them, I'll say Wichita is under contract to be sold in January. So that takes care of that one. Very excited about that. It's a 1.4 times equity multiple over the course of 16 months. We had an unsolicited buyer. We weren't marketing the property, and they came to us and made us an offer that we couldn't refuse. So that takes care of that one. Tacoma 134, you had a question about, and then what was the other property that you mentioned?
Indy 183.
Indy 183. Ross, do you have those off the top of your head on
Yeah,
the terms of this?
So I can jump in because they're both the same lender. It's Rock Capital. So Tacoma 134 is the hotel bay, and we have a 3+1 on that. I'm not sure what's reflected in the sheet. I don't have it in front of me, but we have the same terms as usual with them. We are expecting to be out of that loan much quicker. We're operating as partially a hotel. Bottom 2 floors are revenue positive generating, and then top 2 floors are under active renovation. As we complete the upstairs, we move in residents and continue to increase revenue. And as we shut down the hotel, we become fully an apartment building that's had generating revenue and will represent pro forma stabilized expenses to a refinance lender. So we're expecting to exit that one pretty darn quick. We're going to be refinancing towards the end of next year, as we expect the rates to drop by 50 basis points, just following the dot plot of the Fed. Now that can all change, as we know, but we have another couple of years to remain in that loan if we need to. For Indy 183, we've got a +1 on that as well. And we will be we have 3 properties as part of that are separate parcels. One is a significant property, 100 units. We're actively marketing it for sale. That one property will pay off the entirety of the loan balance, and then we'll hold the other 2 and separately encumber them with just normal debt service, but on long-term stabilized loans. The 2 properties that comprise 36 units out of the total are stabilized already, and it can be refinanced now, but it's not a favorable interest rate market. And we are collateralized by the entire portfolio. So when we sell the 100 unit, we're going to be paying off a loan from the proceed of that property, and then able to, creatively financially engineer the other 2.
Okay, that makes sense. Thank you. And then another question I had was about your final payout in the end of 2028 or 2029. As I understand it, the 2023 cohort is the first one which will be due for their exit, right? So, and you had shared some great graphs before about how by 2029 you'll have like a 57% leverage ratio, and your equity in the fund will be around 280 million. So can you speak to about how much, if you can tell us how much have your investors invested in 2023 alone for this cohort? And how do you expect to do their payout in 2029 if all of them want to cash out?
Emily, do you have the full amount for the SIG 23? What we've raised? I don't have it at my fingertips because it keeps going up.
Let me.
Yeah. I can speak to the mechanism in which we plan to provide those liquidity options. Certainly, we're hoping that investors will love the cash on cash returns and the future prospects of the fund, and that they're not all going to redeem, but we'll be prepared if everyone wants to redeem. And so with that low leverage ratio, one option is a portfolio across collateralized portfolio loan, where we take our leverage ratio up a little bit. Another option is that the general partners buy back shares. And that's another option that we're certainly committed to, because the fund is evergreen, and Ross, Emily, and I are very committed to its long-term success. This is the first year that folks are on a 5-year term. All the capital that we've raised prior to this, everyone signed up for a 10-year commitment. So we intend to be working hard on certainly on their behalf beyond the 5 years, from now until 28.
Okay.
But 16.9 million shares issued this year.
And how much was one share again? Sorry, I don't.
143. So that's about $24 million
Okay, got
in
it.
total capital in 24.2 million roughly so far this year.
Thank you. And I had another question on the dividends. I know that for 2023, it's around, 6.2%. I heard in one of your webinars that you usually anticipate the dividends to increase by around 1.5% each year. So an investor may start off at 6%, but by year 5, they may end up at 12% a dividend rate. So would that be fair for us to tell our investors right now, or is it better to give them a range of 6 to 12? Or can we say every year you might increase by 1 to 2%?
I always like to leave it open. I mean, it's real estate, nothing's guaranteed. It's why there's not a pref. We also have gone as high as 16 already in the past. So it's a range. I always say anywhere from 6 to 16%, depending on the year. And that way everybody, my personal take on it is when selling and going out there and talking to people about it, I'd like to set the bar low, and know that we're always going to be able to over deliver. So that's how I speak towards it, and just, say it increases year to year. That amount varies. Of course, we're going to do our very, very best to increase it by as much as we can, but we have to keep that in fact, that expectation set reasonably, just because there are things that happen. I don't think that I anticipated 2023 to be as tumultuous with the interest rates as it was. Luckily, we're prepared for it. But 12% wasn't exactly something we came into the year expecting. And I'm glad that we had a plan and reserves and were prepared. And also had our investors have really understanding baselines that in times like this, we will, scale back and do what's best for the fund as a whole, rather than trying to just over deliver. Ryan, I believe you and I were talking about the other day, there's something like 80% of our major private equity competitors have just ceased distributions at this point. They're not even doing them right now. So the fact that we're still out there doing distributions, even conservatively, is something that we're excited about.
Right. And within our latest investor deck, and we'll make sure you have the latest with the follow-up materials, there is a pro forma built in there that shows the forecasted share price as well as the forecasted distribution. Aditi, so that is something that you can use as a guidepost, but definitely echo everything Emily said.
All right, thank you.
So go ahead.
Our dividend range would be 6 to 16, equity multiple would be 2.5 to 3x, and IRR would be 25 to 27.
That's really reasonable.
All right,
Mike, do you have sorry.
Oh no, I'm done. Thank you.
Mike, do you have a question?
Yeah, first of all, I appreciate you guys showing up for us and seeing everybody on the team and their faces. And this is my first time raising on a stage, so thanks for the meeting. I have 2 questions. One is on, I guess, tenant placement and occupancy. You guys do an amazing job on, the construction and getting these things turned around. How has your work been with property managers in terms of placing the tenants and the marketing? Since the return on investment is going to be all in the sales and the refinancing. So how do you kind of get the occupancy up? What are your overall strategies? And then the second one is about like government contracts. Have you guys considered that? I'm aware of like government contracts in like furnished rentals, and just hearing about Olympia, it seems like that might be a good opportunity there. People who are coming into work during the weekdays and leaving for the weekend, and I'm aware of like some government contracts for those. I don't know about unfurnished, but is that something you guys have explored?
Yeah, absolutely. So in terms of tenanting up our properties, like I said, there's a massive demand. So we had originally budgeted and forecasted for us to take it to about 6 months to be fully occupied. Right now, we're setting our bench line at about 2 months to have them 100% occupied. So we just go out there, we do all of our marketing across. Well, we work with the best property manager we can find in the area. We also work with an asset manager called Indigo. They're based out of Richmond, Virginia, Richland, Virginia. And they help us secure the best different property manager in each region that we come in, just because we are in so many regions across the country. And from there, we work with them, providing all sorts of marketing support, whether it be grand opening events, working with the cities, working with all the different online resources, and really just blast it out as much as we can. For the most part, we have just a flood of applicants before we even have occupancy. So right now we're really lucky because, like you said, this missing middle, there's just so much demand for it and people cannot find it to the point where it's causing them to be homeless. So we're being really, really lucky with that one right now. So that's super nice because these assets are becoming occupied and cash flowing long before we expected them to, which is putting us in a fantastic position for being able to refinance in their value and all those different things. We're also seeing that we're getting, in most cases, a much higher rate of rent than we expected when we originally mapped out the business plan 18 months prior.
And I can add to that a little bit too.
Yeah.
Because we employ some significant assets. So one being Whitney Wilkins, who's our director of community outreach. And so when we enter an area, she is responsible for engaging in all the Veterans Affairs supportive housing groups, Aunt Mary's Place, Aunt Leah's Place, every agency that provides vouchers to tenants in need that are out there looking for units. So we're doing really active, proactive marketing even before they're online, saying, here's what's coming. We have this many units, here are the renderings, and we're going to be doing more community engagement here, here, and here. So setting up events, setting up meetings, and explaining what we're doing so that we can garner a lot of interest. Beyond that, the media attention is crazy. Emily hasn't mentioned this because she's pretty humble, but she's been all over the news. Fox 13, King 5, Evening Magazine, it's insane. And all the newspapers and everything, the attention to adaptive reuse and what the housing need and the providing the housing within a short period of time has been really impactful. And it's created a lot of buzz. And because of that, we're able to get these units filled from outreach that people are just watching the news. Since it's really it's quite exceptional.
That's awesome. Thank you.
Mike, your point about government contracts, Ross kind of touched on it a little bit. We haven't explored government contracts per se, and I kind of use that in air quotes, but one of the groups that we've worked with recently is the Veteran Affairs Supportive Housing Group. And so of that 96 unit building in Fife that Emily was mentioning earlier, where there were a few homeless folks that were previously homeless that just couldn't find housing that moved into that same property, there were 36 veterans that moved in because they have normally fully subsidized housing provided by their benefits. Some of them make quite a pretty penny, but just couldn't find suitable housing. And it's really rewarding to talk to the veterans down there. There's one gentleman in particular that Ross and I have talked a lot about, and he's just so gracious and appreciative that he's got a ground floor unit that he can wheel his wheelchair into, and it's brand new. And he's never lived somewhere new.
And he's got electric wheels now.
Now he's got an electric wheel too.
Previously, he had to push himself around, but the Veterans Affairs has really hooked him up. They do proactive outreach. We have one of the largest joint bases in the country. It's the 4th largest by population, serving over 210,000 people. And as a result of that, there's a large veterans community. And these folks, they're used to hardship. They're used to not asking for help. And so they have to have people reaching out to them. And Vash just does an incredible job in filling that void. And we're really proud to be part of it. One other thing that I want to touch on is not government related, but it sounds like it should be, is there are a ton of nonprofits out there. I just 2 weeks ago met with the president of the Pierce County Housing Authority, which is a nonprofit organization. This guy's from Denver, Colorado, and commutes in every week so that he can right this ship. And he's just an incredible person. The previous Pierce County Housing Authority president was committing fraud and had to spend some time in jail. So now he's coming out and he's delivering more vouchers to the marketplace and focusing on the actual work, which is providing housing for people in need that don't currently have it. So he has 300 vouchers coming out over the course of the next 90 days. And we are a top priority in terms of allocating. And we fill a ton of these units with vouchers.
Let's see. I think that's excellent. Thank you, Ross. It's one of the questions that I've had people ask about the social impact. So I'm looking forward to distribute this recording out as well. Let's see. So I think going up into the chat, it looks like, oh, we've got a couple of questions too. I'm not sure who was first. We'll go with Agnes. Do you want to jump in?
Yeah, give me a second. Hey, guys. So this is regarding investor relations. So I've had a couple of questions come up before regarding this in terms of presenting the information and the offerings to the investors, and they've asked me, well, why can't I invest directly with Sage? And so what I've told them in the past is, hey, listen, first of all, there's a limited number of spots for investors to invest directly with Sage, and then the minimum is 150K. But I wanted to know, but I do know that from talking to some people that even their investors that have approached have directly invested with Sage, and maybe I'm incorrect, and maybe Emily can speak to this, but how do we handle that kind of question appropriately, given the fact that we're approaching them as a GP group, and if they're interested in directly speaking to Emily or Sage, and asking for that information to see whether they're a qualified investor.
Yeah, absolutely. So we do have direct investors that come to us via your group. I've gotten 2 already in this round where they just approach me. To your point, the minimum is higher. It's $150,000 for anybody who you send our way. And then as of next year, they'll also have to be accredited. So there's that challenge as well for them to do that. But if they really don't want to go through a fund of funds and they want to come directly to us and they have that minimum, then we're happy to take them. We don't have any restrictions in terms of that. Please send them our way. And then what I do, just make sure that they know when I ask who referred you, to say you guys. And then I just shoot Kenji an email and say, hey, count this towards your total and allocate it correctly. So I'm sure that he has some mechanism for reaching out to figure out who it is. I had a gentleman named Tim Lord give me a phone call today. He mentioned that he came in via this group. So I shot Kenji a note and said, hey, heads up, I'm talking to him. I'll let you know when the wire hits. And that's how we qualify that. So everybody's allowed to do whatever they're comfortable with. There's some huge benefits for investors to come in via EV Pro. They get the protections of knowing you guys, knowing that you're managing it, as well as that lower minimum. I don't know a ton about the structure. Our lawyer signed off on your PPM the way your lawyer signed off on ours. But I do know that that lower minimum is really fantastic for them to be able to do that. So that's how I'd handle it. I really have no problem if they come to me and they want to ask a million questions. It's totally fine with me. Eventually I do loop you guys back in if it gets to be too excessive, but that's only happened once. So.
No, thank you, Emily.
Of course. We want everybody to be comfortable. It's a lot of money. I'm never going to be the person who sits up here on her high horse and is like, well, I'm too good for 10 grand. That's just not how I am. Ross and I started this with $20,000 that we saved from working in a kitchen and a tanning salon and some wedding gift money. So we really understand that like you can build anything with a small amount of money, and that everybody's just trying to hustle and make that American dream happen.
That's awesome. Let's see. I'm not sure who is next. I think Josh has been hanging out for a while with his hand up. You want to jump in, Josh?
Yeah, you know what? You kind of answered it a bit. I just was kind of trying to figure out, and we have to discuss this as a fund too. And if we have, I apologize. But what happens to our fund of funds at 5 years? What do we do with that? And then to piggyback onto that, you talked about relationships, and I also know that you at some point you plan to be internally funded, right? Like, so not using other people's money. So I'm just curious.
Not that we don't love you all and appreciate everything you're doing for us, but yeah, ideally it'd be nice to be self-fulfilling.
Yeah, I know that's a goal of yours, which is awesome. 100%. I was just curious, at this end of 5 years, will you be able to absorb these people if they do come directly to you? The
math is saying that we should be able to do that. and our goal is to be able to do that. I want to bring everybody with us. So
Yeah.
if you were one of our original investors, you're going to get a preferred treatment. You just are, because you were loyal to us at the beginning when you took the risk. So, you know, Ross and Ryan
expect
and I
that-
are going to have to figure this out, but yeah, we expect
You
to be able
expect
to let in. Now, there is going to be a challenge. I will say this. I believe Samantha asked the question, like, what's going to happen to the LPs at 5 years? It's going to depend on what you guys decide to do with your fund of funds, as well as how we're going to integrate that in. I'm confident, knowing Kenji and Letty and Ross and Ryan and I, that we'll be able to sit down and have a conversation and figure out something that we all feel good about. And then we'll be able to go through and offer that to your LPs and say, hey, this is what we've negotiated on both ends, whether that means that they roll into Sage directly or you guys extend your fund of funds, whatever that looks like. I don't have a crystal ball. 5 years is a long ways from now. But I have such a deep respect for Kenji and Letty. And they go way back, and Ross and I and Ryan and I, we believe in all of that kind of handshake loyalty. So I'm confident we'll be able to figure something out, but to just be very clear, I don't know what it looks like yet. Right now, I just know for the next 5 years, I'm going to make you guys as much money as I can. Sorry to be vague. I know that's not a great answer.
That's awesome. It's appropriate. You can't predict.
Yeah,
But the relationships you guys have, it's one of the reasons why I have tons of confidence. I haven't been there for a decade, but I know you guys have been there for more than that. So
yeah.
that's awesome.
Yeah, Ross and I bought our first rental 2010 off the courthouse steps, sight unseen, no keys. They told us to go break into it. I'm like, okay. So it's changed a lot over the years.
I think there
It's
was
too bad you
one.
didn't have a video of that. Ryan, go ahead, man.
Oh my
Sorry.
God. Thank
I
God
just
we
want to
don't.
make sure we got to all the questions. It looks like Nick, maybe you had some questions that scrolling up here, who's the single largest investor group in the fund and what percentage of the fund did they have? Emily, you want to take that one?
It's me. Right now, the single largest individual fund investors are Ross and I. And then we have a few LLCs that hold a pretty big chunk. I think that I'm gonna need to do the math, and I can have this sent over, but EB Pro's up there. And then we have one other entity that is closer to that 8 million mark as well. So we have a few larger groups that have come together to bring in funds, but the single largest shareholder is Ross and I believe we're approaching about 5 million. I have to double check the numbers on it, but we're about 5 million in our holdings.
I think between Ross, Emily, myself, and my wife, we're about 10% of
I think that's right.
the total LP capital contributed, or the total shares so far. Nick, your second question was about the capital stack. We don't have any pref equity or mezzanine debt in the fund. It's just LP equity and then senior debt. We can send in the latest investor materials. You can see the debt breakdown. And then some contractors have personal relationships, other conflicts of interests with that, Emily?
I think there potentially could be, but we don't currently have them. And at the end of the day, we have to do what's best for the fund because the contractors are also invested in the fund. And so if that means that we need to work with somebody else, then we'll work with somebody else. That's why we have multiple contractors. If we have to make some hard decisions, then we have to make some hard decisions. We've done it in the past. Ross and I just recently bought out one of our original partners because we felt like that was what was best for the fund. So if the question is, are we willing to be ruthless? Then absolutely. So we just don't allow them to happen. And we've got a good relationship to ensure that that's not an issue. And part of that is him being a shareholder as well.
And speaking to Olympia specifically, Ross, feel free to clarify anything about what I'm about to say, but we're actually getting 2 bids on the project. So we have our national contractor that works outside of Washington. And then we have, the gentleman that we're talking about here in Washington. That typically does all our projects here. That national contractor hasn't done any projects in Washington, but we're having them bid on Olympia 196. It's possible that they'll be able to get the project done quicker, and we may choose to go with them. And so we do get multiple bids on our projects just to make sure that we're getting the best price possible and also executing on the best time possible.
Precisely.
A question. There's a question here about how often we do chats with our investors. So I will also send Nathan in my list of things our upcoming webinars. We've got one on December 5th that we're hosting, and then I believe Nathan's gonna set one up for the team. Nathan, help me out here on the date. What do we decide?
Monday, the
27th?
27th. Yes.
27th. So those will be coming out with links as well for you guys all to be able to send your investors your way. It'll be Ross, Ryan, and I, or a combination, giving the spiel about how Sage started, what our model is, what our funds like, and what our expected returns are. And then there'll be a Q&A at the end as well for every investor who's interested. We welcome everyone. There's no silly questions, so feel free to send them our way.
That's great.
We also send out quarterly updates. Emily mentioned we just finished writing up one now, so you guys will get to see what those will look like. And our anticipation is sending those out quarterly going forward. So it isn't just now, but it is also once people become investors, and we want to make sure that we keep up a high level of communication with them. So we always have an open door.
That we have Grant. Okay, do I have any more hands up at the top? Sorry, I have to scroll.
Emily, I have a question.
Oh, perfect. Yes.
Do you have any plans to extend into any other asset classes besides hotel to multifamily in the next 5 years?
Currently, we do not have any plans, but that doesn't mean that we won't. So wherever we can find the highest rate of return is where we will go. So Ross is like the absolute like curious cat who's always out looking for new opportunities. It wasn't too long ago he was exploring, was it storage units? And the numbers just didn't pencil. So we decided not to move forward in that direction. Right now, we know we've got about 70,000 of these rundown nasty hotels in the country currently. So we'd like to buy as many of them as we can in the next 5 to 10 years. We also do realize that there are only so many of them. Like I said, there's only 70,000 of these hotels out there. So we know we are going to have to change and shift strategy as our fund is evergreen and it's going to continue to grow over the years. So that is something that we are looking for, that next opportunity. But currently we are focused on these hotel conversions, and we don't have anything else under contract, but that could change. And we will keep our investors and our LPs apprised of that change as we shift in different directions. But we don't have any plans, but that doesn't mean it won't happen.
Yeah, that's
Ross?
well said. And I wanted to comment that thank you. I love the curious cat here. Our real goal is to compound upon our investment. When we started investing in real estate, it was not because real estate is something that we love emotionally and are attached to. It's because it has a phenomenally well-rated, risk-adjusted rate of return. And we simply chase that. And so we're looking for the opportunity to increase value to the extent that we can capitalize upon it at the largest rate of return annually. And then we capture that and reinvest it. And that's why we have our 5-year hold. And that's why we produce an estimated 3x equity return in 5 years. And we couldn't do that at the individual deal level because we're not compounding capital at the individual deal level. So what your investment and our investment empowers us to do within the fund model is to tax defer, reinvest, apply debt and still cash flow above 1.25 DSCR and reinvest. And as we reinvest, we're compounding on our otherwise already earned profit. And as a result of the eighth wonder of the world, we are blessed with phenomenally unattainable rates of return that are risk adjusted and tied to fixed assets. So we can weather storms. So I can't say enough about the power of real estate investing. It's changed my existence. And I am so excited to be able to offer the others the opportunity to do the same. And together, we are able to do a whole lot more as a result of, merging the investment power. So we can obtain more transaction volume and therefore compound more quickly. So that's what it's all about. And if motel to apartment conversions is where that's at, and as that starts to become less interesting, perhaps something else will be. I can't predict that, and I couldn't have predicted where we are today in respect to hotel to apartment conversions, because there are variables in play that I don't control, but I'm certainly looking for and trying to be aware of because I find it fun. And I'll get off my soapbox, but the curious cat has spoken, and I really appreciate all your time.
Great, thank you, Ross. And I think my last question is to do with your cash reserves. You had mentioned in the past that you started 2023 with $3.3 million in cash reserves, and you were aiming to increase that to $10 million by the end of this year. Just wondering if we are on target to hit that.
I am thrilled to say that that is the case as of today. I flew back to Washington to meet with a couple of specific people, and we got 2 yeses. And so I'm thrilled to be able to get to our. We have a actual 5% of assets, real estate assets, is our reserve goal. Right now, that's about 7 million, and that's increasing. So we want to stay on top of that, and we have verbally secured, and we will contractually soon.
That's great. Thank you.
Wow, this has been a phenomenal meeting. I want to thank our team too for asking Aditi asking awesome questions, taking notes on these. This recording is going to be invaluable for our team. And Ross and Emily, Ryan, Garrett, thank you so much for meeting with us. And we're really excited to meet again on the 27th and have our investors join and kind of learn firsthand, what it is we've been talking about from you guys. And then, it's great. We have some different options too for, I think 12.5 to have them join too.
Yeah, we're really excited. We couldn't be more appreciative for you guys to be here, to be supporting us in this, and just let Nathan know if you have any questions for me. I'm happy to continue to compile a list and add to my 86 answers. It's always great to hear everybody's perspectives and get that diversity of thought. It couldn't be more powerful and important. Just to hear how everybody approaches it is always important. So much of what people do with their money is made in an emotional decision space. It should be logic, right? It's numbers. But it really, I would say that 85% of investors make it based off of emotion. So hearing how everybody approaches that and manages their emotion when it comes to money is always super helpful to hear that perspective. So please feel free to reach out, let Nathan know what questions you have. And then I will follow up with, I believe the recording will come to me since I'm the one who clicked it. So I'll send over the recording as well as the webinar schedule, our current marketing deck that has some breakdowns that you guys were looking for in the chat, as well as the renderings. I'll resend to those so everybody has those, the investor update from Ryan, and some of our recent media articles, since I'm apparently too humble to have talked about them enough. Did I miss anything in my notes? Did I get them all? Okay, well, Nathan, let me know if I missed anything. I will send these over, to be perfectly honest, once my children go to bed. And so you should get them this evening.
That's fair. Thank you guys so much for your time. And it's just a pleasure getting together and talking with you guys. So thanks so much.
Nice to meet you all. Thank you guys.
Fantastic. Thank you.
Yes. Thanks everybody.